Hello guys, so today we will see how to create an amortization schedule or amortization table in simple words. So what exactly is amortization schedule or amortization table? So it's a table which shows all the interest payments, all the uh, monthly EMIs, your principal components. So all this stuff at the end of each month, how much principal you are left. So these calculations will be displayed in an amortization schedule. So bank generally provides this amortization schedule when you take a loan. Okay, so let's see how to create an amortization table. Okay, so let's take an example. Suppose you have taken a loan of 100,000 or 1 lakh, let's say. So the loan amount is 1 lakh. Okay, now the rate of interest, let's say it is 10%. Okay, just want to add one more thing over here. So the rate of interest is per annum, so it is per annum. So if we want to calculate interest per month, it would be nothing but its rate of interest per annum divided by 12 to get a 1 month rate of interest. Okay, so this is nothing but 1 month rate of interest. Next is tenure. What would be the tenure for the loan that we are going to take? So let's say the tenure for the loan is, let's say, 5 years, and this tenure is in years. Okay, also, so when we make an EMI, it would be a monthly payment, right? So when we calculate the EMIs, it would be monthly. So to calculate the number of months for 5 years, we just multiplied years with the number of month in a year to get total months. So it will be nothing but number of years multiplied by 12 to get the number of months. Okay, so let me mention over it here so that you should not be confused. So this is monthly rate of interest. So this is monthly rate of interest, and this is tenure in months. Okay, this monthly ROIs is nothing but this one, and the tenure in months is nothing but this one. Okay, now we go to three components: loan amount, rate of interest, and the number of years that we are going to take for the loans. Now our amortization table will have total 60 payments. Why 60? Because we have taken a loan for 5 years, which translates into 60 months. Okay, so this, the first column would be EMI month. So EMI month would be 1, 2, that would be nothing but it will be till 61. Okay, we got 60. Okay, now the next part is monthly EMI. How much EMI we'll be paying every month. So there is a formula in Microsoft Excel, or even in Google Sheets also we have the same formula. So the formula that we are going to apply over here for calculating the monthly EMI is equals PMT. Okay, so in PMT we have 1, 2, 3, 4, 5 components, right? So the first component is a rate. So what would be the rate of interest? So rate of interest would be nothing but it's since we are calculating monthly EMIs, so the rate will be the monthly rates, and the monthly rate we have calculated is this one. Okay, so this will be the rate, and we want this rate to be applicable across the months, right? So this rate of interest we can freeze the form, we can freeze the rate of interest. Simply press F4. Okay, next component is number of period. For how many period we want that monthly interest, the monthly EMIs. Obviously we want the number of period to be 5 years, but since we are making a monthly payment, so it would be nothing but it's a 60 months. So again it will be 60 months. This number should also be freezed. Press F4. Then what is the next component? It's a present value. So a present value means the loan that you have taken. So why it's a present value? Because it is the amount which is worth of how many monthly EMIs we are making. So if you see, this present value is the present value, the total amount that a series of future payments is worth now. So obviously it's nothing but a loan amount. Okay, and we want that monthly EMI should be in a positive number, so we just use minus sign before the loan amount so that we can get a series of monthly EMIs in a positive numbers. Okay, so just use minus sign before the loan amount. Okay, this number should also be freezed. Okay, now the next is the future value. So what exactly it is? If you see the explanation over here, it says is the future value cash balance you want to attain after the last payment is made. So generally what happens is that when you take a loan, we want that when we make our last payments, last monthly EMIs, I want that total principal should be zero at the end of my last payments, obviously, right? So it would be nothing but zero. Okay, the next is so the monthly EMIs that we'll be paying, will it be at the end of the period or will it be beginning of the period? I mean end of the month or beginning of the month. So generally it would be end of the month. So what is the difference is that if you make a payment at the end of the period, what generally happens is that you will utilize all the funds, you will utilize that amount of funds during those months, right? So the interest will be charged for that month during those 1 month. And what exactly beginning of the period it says is that when you take a loan, the interest is applicable till the beginning of the month. Okay, so it's generally kind of the way we calculate the interest rates. Okay, we can impute or we cannot, I mean we can ignore it also, right? So just ignore it and just use bracket to close the formula and see, this is the monthly EMIs that we'll be paying if we take a loan amount of 100,000 or 1 lakh for 5 years at a 10% rate of interest. Okay, just drag the formula. See, we'll be making 2,124.70 dollar or a rupee, not rupee exactly, the sign is in dollars. So this much amount of EMI we would be paying every month. Okay, now this monthly EMI includes my principal as well as interest amount. Okay, so how much interest we are paying out of this total EMI? So just now we calculate the interest amount. Okay, so the interest amount formula is, we have the formula that we have is equals IPMT. Okay, again we have similar number of parameters over here, only addition is that period. So the first component is rate. Obviously we are using monthly interest rate, freeze the row. Then we have a period. The additional component over here is period. So what exactly period is? So for which period we are calculating this interest? So obviously the first, we are calculating for the first month, so period would be nothing but first month. Okay, we will not freeze this row, because when we drag the formula, we want each row would take the corresponding row in the formula. Okay, so then we have number of period. Obviously it's a 60 months, that would be freezed. Then again we have present value, it's nothing but the loan amount, and then the future amount that you want after making the last payment, and obviously we want that to be 0. Okay, now press the enter. We got 833. Just drag the formula. Okay, so if you see, in the first month we are making 2124.70 as a monthly EMI, and out of that 833.33 is my interest amount. Okay, if you see, my interest amount is decreasing as we move towards the last payments of our monthly EMIs. Okay, now we calculate the principal amount. Okay, there is a spelling error. Okay, so principal amount, how would you calculate the principal amount? Obviously my monthly EMI includes my principal as well as interest amount. So my principal would be nothing but its monthly EMI minus interest amount. Okay, this is my principal amount. Drag the formula. Okay, if you would see, my principal amounts increasing as we move towards my last payment, right? Okay, now we calculate the outstanding amount at each month after paying our monthly EMIs. Outstanding amount. So after paying our first EMI, how much outstanding balance we would have left once we make our first EMIs? So it's nothing but initial loan amount, that is my total outstanding balance at the start of my EMIs, minus my first principal amount. Obviously we will deduct principal amount. Why principal amount? Because we are calculating outstanding amount, and each month we will just subtract principal amount to get my outstanding balance. Okay, because my interest will be calculated on the outstanding amount only. Okay, so the first month interest amount is calculated on the overall 100,000 amount. Okay, so the next interest will be calculated based on the outstanding amount at the end of first month, divide minus principal amount that we have made in the first month. Okay, so it's nothing but outstanding amount minus first month principal amount. Okay, so this is the principal, the outstanding amount after we make first EMI. We can, okay, now what would be the outstanding amount at the end of second month once we make our second month EMIs? It's nothing but it's outstanding amount at my previous month, at the end of my previous month, minus principal amount that we'll be paying at the end of second month, that is the second EMIs. Okay, now we drag the formula. We'll see that once we make the last payment, that is EMI on 60th month, our total outstanding amount should be 0, because we used in our EMIs and interest amount, if you would have seen, we have mentioned 0 at the last, because we want that outstanding amount should be 0 once we made our last payment. Okay, now we'll see, drag the formula. Okay, you can see our last outstanding amount is 0. Okay, so when we make our last EMI, the 60-month EMIs, our total outstanding balance would be 0. Here is the moment where our total loan amount will be paid off. Okay, okay, so this is the total entire calculations of the amortization table. Now we calculate the total interest amount. If you see the principal amount and we see the interest amount. So principal amount is nothing. Even we can just simply copy this one, or we can just simply sum this one as well. Total principal amount, we will get the same value. Okay, 7,000, and this total interest is nothing but the total interest that we have made during our loan tenure. Okay, okay, this is, so if we take a loan amount of 100,000 or 1 lakh, we will end up paying an interest amount of 27,482.27 during those 5 years. Okay, so if we plot a pie chart, principal and interest amount C. Okay, so this is the pie chart. So if you see, the blue one is principal amount and the pink one is the interest amount. Okay, so this much amount of interest we'll be paying during the 5 years